Yesterday, you went through the credit basics presentation, and then you had this basics of debt. So you read the article that was linked in here, right? You had this article that was linked. You went through the presentation, you read this article, and then you had a couple of questions that was based on that to gauge your understanding. So let's talk about this really quick. Number one says, explain why the article states that some debt is good debt. So the article went through and talked about how debt, when used wisely to purchase things that hold long-term value, can be good, right? So, incurring debt to buy a house, as long as you can manage that mortgage and the associated costs with owning a house, okay, that's going to retain its value and it's going to actually appreciate in value, meaning the value goes up over time. All right. Taking on debt to open a small business, right, is risky. But if the business succeeds, that could be good debt because it's leading to even more income, right? Debt to go to college could be good debt if you're wise about how much you're borrowing, if you understand how the repayment works, and if you are wise in terms of how you manage your school, and that you're not, taking on debt to major in or to get a degree in something that doesn't have a lot of job prospects. Financially, if you can swing it, great. But if your job isn't going to be able to pay off the debt that you're incurring to get that education, could be risky, right? Or if you take out loans to go to school, but then you find yourself changing majors 2, 3, 4 times. Okay, that's going to prolong how long it takes you to get through college to get your degree. Again, that's a little bit more risky. Okay. But used wisely, right, that can be good if it's used to acquire things that hold long-term value, such as, like I said, such as a house, a small business, education loans, if you're smart with it. Okay, number two, the article states, in reality, using a credit card to make some purchases isn't itself bad. Not moderating your spending during the month and not paying your full balance when the bill arrives is where debt goes bad. All right. And so why does this happen? Well, buying with credit is incredibly convenient, right? You don't need to carry cash with you. It's easy to use it with online shopping. It's easy to kind of think in terms of like, oh, I want that right now, and I'll worry about paying for it at some future time, right? So that convenience can really easily lead to overspending. To avoid this, right? How can you make sure that this doesn't happen? Treat any purchase on a credit card as if you were purchasing it with money from your checking account, right? Treat it like a debit card, so that every purchase that you make, you're putting it into your budget as an expense. Okay, and then that way, when you get your credit card statement, you can pay it off in full every month. Okay, if you're paying it off in full every month and you're not accumulating interest, you're not paying more for those purchases, it's still risky because it's still easy to overspend. But if you are diligent about it, if you're responsible, okay, that can help avoid some of those pitfalls. Number three says, paragraph 2, the article states how debt really works. In your own words, summarize it. So again, you're putting this in your own words. It's not necessarily a right or wrong answer, but in general, when you buy on credit, you're a borrower of money. The credit card company or the bank is the lender. They're the ones that are essentially footing the bill for your purchase. You have to pay that principal back, the amount that you're borrowing, you have to pay that back plus interest. Okay, so the extra cost of using somebody else's money. All right, and that's essentially what credit is. That's essentially how debt works. Number 4, why is it that little charges can be the biggest problem to control debt? So it's kind of a saying that you're more likely to stumble over a small rock than a big boulder, right? Big things are really easy to see and to navigate around and plan accordingly. The small things are what can very often trip you up, right? So it's really easy to lose track of a $5 purchase here, a $10 purchase here, $15 purchase there. It's really easy to kind of underestimate how many of those small purchases you're making. You don't often forget a $200, $300, $400 purchase, right? But you might, over the course of a couple months, forget about 20 little $10 purchases. Well, that is now several $100s. Okay, so it's really easy to kind of to overlook those small purchases, but a lot of small purchases has the same impact as one large purchase. Okay, so those easily forgettable transactions if you're not being diligent about it, if you're not keeping track of it, and treating it like a debit purchase rather than a credit card purchase. Okay, those can add up. Number 5, after reading the article, find the best quote that the author uses to describe their main point. Again, just kind of looking over some of your submissions, a lot of you had pretty good quotes. One that I liked was that the one that said, debt is both benevolent and malevolent. Deciding which form it takes is entirely up to you. Right. So again, debt can be good or bad. It can be a really positive force, or it can be an extremely negative force. It's all a matter of how you choose to manage it and control it. All right. And then number 6 from the article, what's the most debt that you should have a month, including car loan, credit card, electronic store loan, if you are making $2,000 a month. So if you remember, they had kind of that 20-10 rule. So $2,000 a month income times 20% is $400. Okay. So ideally, you shouldn't have more than $400 in debt at any given time. And that's at 20%. More conservatively, if you can keep it close to 15, that would be $300. Okay. Number 7, what suggestions do they give throughout the article for debt control? So again, use cash when possible, especially for consumables, things that once they're used, they're gone, right? Food, gas, things like that. Those are consumables, because once you use them, once you consume them, they no longer exist. So things that don't retain value, try to use cash for. Keep bad credit load to 20% or even better to 15% of your monthly income. Use credit purchases that hold long-term value. Again, like an affordable home, college education, if used responsibly, and so on. Okay. So that was the main gist of the article. And again, it touched on a lot of what the presentation went through. Okay. Moving forward, it is this financing your life. Okay. This presentation is going to walk through, we've talked about ways of differentiating types of loans, looking at revolving credit versus installment credit, right? You looked at, loans versus credit cards. This will look through additional types different ways that we can kind of categorize credit. All right. So this is a Prezi, not a PowerPoint. So you're going to have to use the arrows down here and just click the next arrow. Okay. So the first thing that it'll do is it will kind of differentiate secured loans from unsecured loans. We will differentiate charge cards from credit cards. All right. They both allow you to buy on credit, but they do function a little bit differently. Okay. Credit cards, generally what we think about when buying on credit. Okay. MasterCard, Visa, Discover, those are all credit cards. American Express, though, is a charge card. There's another charge card called a Diners Club card. Some store cards operate as charge cards, though most individual store cards operate like credit cards. But still, this will walk you through some of those differences. Okay. Let me fast forward. Safeguarding cards, whether you're looking at a charge card, credit card, even a debit card, that applies to all of those types of cards. All right. And then it'll look at sources of loans. So it'll walk through 4 types of sources that are really reputable and reliable and would be your best bet. 3 of those types we've already looked at. Those are deposit institutions, commercial banks, savings banks, credit unions. There's also a non-bank option, a non-depository institution. So you can't open up an account and put money into it, but you can still take out loans from it. Okay, that one's the most variable, and it's harder to make blanket statements about, just because it's called a consumer finance company. I'll get here. Okay. If you have really good credit history, if you have good credit score, you've managed your credit well, you can get a really good loan here with very favorable interest rates. If you don't have very good credit or no credit, okay, you might still be able to get a loan here, but the interest rates are going to be much higher. All right. So you can't really have just a blanket statement whether these are good or bad. They're reliable, they're legal, and they're generally favorable somewhat to customers, though the degree of favorability is going to vary based on the customer. All right. So you'll look at those 4, then it'll go through an entire list of sources, more sources, all right, that you can get a loan from, but that are not good ideas. Okay. You want to avoid these because they are so expensive because of fees and interest that they charge. Okay. So you'll go through those. The last one is a pawn shop. It'll look at one more option, which is a loan shark. So up to that point, everything is legal, though some are better than others. When you get to loan sharks, okay, loan sharks, you want to avoid at all costs, okay? These are individuals that lend money illegally, all right? To operate a lending service legally, you need either a state or federal license. Loan sharks simply don't get that license. All right. Most states regulate the level of interest that can be charged. They put they cap those interest or the fees. If loan sharks don't bother to get the license, they're probably not going to follow the law in terms of the interest that they can charge. States regulate how, and actually, there's a federal agency that regulates how debt can be collected. Okay, like collectors can't call after 9 o'clock. They can't call your place of employment and harass like your boss to pressure you to pay, right? Things like that. Again, loan sharks aren't following the law with regard to having a license. They're not following the law with regard to the interest they can charge. They're not going to follow the law in terms of how they can collect that debt either. So they can use intimidation, force, sometimes violence. These can get very dangerous. So again, avoid those sources. Okay. Once you get through that, we are going to move next to 5.1, understanding credit cards. All right. And so this looks at, the presentation yesterday talked about credit cards, a little bit just in the broader sense of what credit is. It gave examples of credit cards. This one looks very specifically at credit cards. So as you go through, the first thing, it compares debit cards to credit cards. Okay. They're very similar. Both plastic cards allow you to make purchases, but the source of funding, where the money is coming from, is obviously very different. Again, benefits of credit cards, okay, how to pay it off. Again, yesterday's presentation touched on that some, but this goes into a little bit more detail, APR, where a lot of the new information is looking at credit card offers. So when you apply for a card, when you get an unsolicited offer through the mail or online, right, there are certain things that will be disclosed to you. So this walks through a lot of those things that would be in the card offer, all right? Things like identifying the APR for purchases, for cash advance, for transferring balances. So if you have one card that you have a balance on that has maybe a higher interest rate and you want to move that balance over to a new card that has a lower interest rate, okay, that's oftentimes a different interest rate than purchases. So that's the APR for balance transfers. Okay, it'll have things about repayment terms and minimum interest or finance charges. Okay, penalties if you're late, if you go over your credit limit. If you send in a payment that gets rejected, right, so on. Talks about applying for it, okay, and then it looks at the statement. So every month you'll either get a statement through the mail, or much more common now just to get notification that you have an online statement. And so this walks through the different parts of that. Okay, it'll identify what the previous balance was at the start of this cycle, the amount of purchases that you added to the card, if you did any balance transfers, if you brought any transfer, like I said, if you transferred any balance over from another card, or if you used a credit card at like an ATM to get cash out. Okay, that's a cash advance. Those have other interest rates. They also have fees sometimes involved with them. So you'll see purchases, any of those other transactions, any fees or interest. Okay, it'll also identify how much you paid off of the card. So that is right here in payments. All right, shows you then your new balance. Your credit limit is the total amount that you can owe on that card at any time. So in this example, there's a $2,000 credit limit. The new balance is $1,786, which means that there is $214 in available credit. So there's $214 left that can be used to get all the way up to that maximum amount. Hopefully, you're never maxing out or even coming close to maxing out that credit card, but sometimes it does happen. All right. And so that shows you how much you have left. Again, this kind of breaks down some of the key aspects of it. All right. Some repayment information. Okay. So it says if you make only the minimum payment. So even though you owe $1,700, almost $1,800, the minimum payment that you have to make this month on this card is just over $50. Okay, so if all you do is make that minimum payment every month, if you don't make any more purchases, okay, it's going to take 8 years to pay it off, and the total will be almost 1,000 more than what you would owe. Right, your balance currently is 1,700, but interest will accumulate for as long as you owe money, and so paying just the minimum is going to take 8 years to pay it off, and you'll end up paying $1,000 more over the life of that. Right. Whereas if you can increase only by even less than $10, $9, going from $53 to $62, you cut your repayment from 8 years down to 3 years, and you save over $500. Okay. So it shows you how just even small increases in paying it off can have huge dividends down the road, right? Because as you owe money, we talked about this yesterday, interest compounds, which means interest grows on the interest, not just what you borrow. And so owing money rapidly can expand, right? It can grow exponentially, but paying it off also has the reverse effect. It can pay it off quicker because now you have less accumulating. All right. So it goes through that. You'll see that each one, there's numbers here that corresponds with the numbers on this statement. So again, it talks about possible fees, changes in interest rate, a list of all of your transactions and purchases, and so on. Okay, and then a breakdown of the interest rate that's being charged and how much of your balance was subject to those different rates. All right, so spend some time, go through that. In your notes sheet, there are examples of these statements. So you don't necessarily need to look at it on the screen if you're following along with the notes, right? You can just look at how this reads out and compare that to your notes right there versus trying to go back and forth. All right, so do have those note sheets so you can spend some time on it, right? It's not a long presentation at all, but there is some valuable information on there, particularly how to read those credit card offers and how to read those statements. So do take your time as you go through this. All right, it shouldn't take that long. So don't feel like you have to rush to be able to get everything done today. All right, so go through that presentation, complete the notes that go with it. You have one worksheet to complete today. Understanding your credit agreement looks at a credit card offer. That first page walks you through what's called the Schumer box. This must appear on every credit card offer. It details the interest rate, okay, that you may be charged. You can notice that there are 3 different levels here based on your credit worthiness. We said at the beginning of class today, right, the best customers, the ones that can manage their credit the most, will get the lowest interest rate. So if you have great history, okay, and you qualify, you'll probably be toward the 11.9. If you have if you have incomplete credit history or you have some problems with your credit history, if you're approved, you're going to have a higher interest rate. All right. Transfer interest rates, cash advance, okay, penalties, other fees involved, and so on. All right. So then based on that Schumer box and that offer, you're going to answer these questions. So part 1 is simply just summarizing the information in that offer, in that Schumer box. Then there's a link here to a credit card payoff calculator. You are going to figure out, you're going to do some calculations to figure out, the average monthly payment and interest and so on. Given the parameters that are in these questions, and then you'll go on to the 3rd page. You'll go through the same process, but instead of having a great credit and a low interest rate, you'll see what the cost would be if you had poor credit with a high interest rate and so on, and then you'll summarize your findings. Okay. Let me point out really quick this payoff calculator that's linked here. It's from a website called creditcards.com. All right. So the information that you'll put in here will be on the left-hand side. So I think you're buying an $1,100 laptop or something, and let's say that you have an 11.9% interest rate, right? Whatever. Follow the prompts for the specifics if I'm not remembering that correctly. Then it asks for your current credit card issuer. Put whatever in for that, okay? It gives you a different options, okay? It does not matter what you put in because that is not going to impact the math in the calculations. All right, creditcards.com has some really good calculators and really good information and really good articles, but credit cards also pay to have their cards marketed on this website. So if I go through, for example, and I select a Discover card, okay, when it gives me the answer, it'll also have some advertisements or some recommendations for other credit cards that I may be interested in. If I already have a Discover card, they're not going to show me other Discover cards. They're going to try to get me a Capital One card or a Citibank card or whatever. All right. So if I choose Citi, right, then I may see in the recommendations a Discover card, whatever. So this is simply for marketing purposes so that they can give you different card offers. All right. So just choose whichever one you want. Okay. So you'll fill out that information, you'll calculate it, okay, and use those calculations to complete this worksheet. All right. And that is what you need to get done for today. As always, let me know if you have questions. Otherwise, the rest of the time is yours. See you guys.